What's the common denominator to all these things that have been happening in the last like few months or so? Is it all a story of inflation, or is there something else that's also going on that's worth discussing?
I would say the two common denominators are fiscal policy. So the fiscal stimulus on one hand, that impacts demand levels, and then of course, the virus, the lockdowns, the logistics there have kind of been backed up over the past year and a half. And so if you look at the supply side, obviously when you have basically supply constraints, shipping constraints, right? There's only so many ships built, right? That can transport things from China to elsewhere. And so when you have a highly global supply chain, you increase efficiency, but you decrease resiliency. And so we've spent the last 25 years making our supply chains as global and efficient as possible, but less resilient than they would be if they were, more kind of in-house. Because there's so much debt in the system, and because they've so relied on using increasing prices of financial assets to prop up the market, and because of the structure of the global dollar system, the U.S. is very financialized, more so than even most other developed countries, and we're very reliant on our asset prices being elevated. And the average consumer only has, say, a month before they run out of money, right? They don't have a lot of savings, and so when we encounter this problem, they in any kind of fiat regime, right, when they're faced with like nominal collapse, right, they always choose to print. And so we saw that this time. That was kind of my base case going into this. And there are certain things that are worse than others, right? So the big kind of back in 2008, the biggest problem with how they did that was that they bailed out the banks and things like that, but they didn't bail out the homeowners, right? So it was kind of the worst of all worlds. It was like socialism for the rich and capitalism for the poor. And so that's why you had on different types of populism from different sides of the political spectrum. So you had the Tea Party on the right, you had Occupy Wall Street on the left, and you got a lot of pushback for that. And this time, they kind of said, okay, socialism for everyone. We're gonna bail out companies. We're gonna send stimulus checks. We're gonna send all sorts of things. And so on one hand, it's less bad than what the 2008 thing was, right? But it's so you have, for example, personal income for the median person went up rather than down, because if you include all the stimulus they got, it kind of offset a lot of their issues, not for every single person, but on a kind of a large aggregate. But that does come with consequences. And then there's kind of subsets of their policy response that I think were terrible, like the Fed buying corporate bonds, for example. I think that set a really, really bad precedent. And certain policy actions like that. I also think that the Fed's kind of, like verbal navigation of what's going on was in large part inaccurate and misleading, and kind of it's like they can't say certain things out loud, so they have to kind of say things in ways that end up sounding like political speech. So we just kind of kind of make fun of them, and so I would say it's a very mixed outcome, but they just didn't have that many options. So pretty much all of their options were bad, more or less, and they kind of could navigate that in different ways, and I think they somewhere in the middle, I would say.
When we were printing money and giving those to bank bailouts, it seemed like that inflation went into asset price inflation.
I think that's a pretty accurate way to describe it. And when I refer to decades ago, it's not only that 2008 crisis, but it goes back to, say, the late 90s. And so basically, I mean, you could actually go back all the way to 1987 under Greenspan, where we started to do this concept where the Fed begins caring about asset prices. So before then, they cared less about asset prices. But starting with that 1987 crash under Greenspan as the Federal Reserve Chair, they started to have a kind of an unofficial mandate to bail out the stock market when it crashes. And so that started in 1987. And then we started to see it in the late 90s when you saw long-term capital management for people that are aware of big implosion that happened in markets. It's not really well versed among, say, retail investors, but most people are involved in, say, macro level trading or familiar with that. The Fed and the banking system basically had to bail that out. They could have chosen not to, or they could have done it in a different way. But so they kind of, we started to get this concept of the Greenspan put, the idea that if markets go down, Greenspan will be there to do things. And so even when you had a dip in, say, the late 90s, right, after a massive economic boom, massive stock price boom, when you had a pretty small dip, Greenspan came in there, cut interest rates, and it was always very accommodative. Always erring in the side of lower interest rates, very accommodative, try to get those asset prices back up. And so that really kind of set the stage for the dot-com bubble. And then when that, fell apart, then they said basically we need to inflate a housing bubble, right? We need to get this all back up again. So they cut interest rates, and that kind of led to a housing bubble boom. And then when that fell apart, you had to reflate the banking system and then kind of prop up the stock market again. And so really ever since the late 80s and especially in the late 90s, they've been in this thing where they just keep pushing up asset prices and keeping interest rates as low as possible. And that really set the stage for a lot of things we're experiencing now. Those low interest rates basically incentivize companies, households, and all sorts of different entities to take out a lot of debt, especially because they're trying to buy, say, high-priced homes and things like that, let alone what corporations are doing with their balance sheet. And so that, we've had this kind of multi-decade structure of encouraging debt accumulation. And when you get down to where we are now, where interest rates, eventually hit zero and debt's extremely high, they've boxed themselves into a corner. And so that goes back to I learned a lot from Ray Dalio and his concept of the long-term debt cycle, which is basically that in a normal economic cycle, like a 5 to 10 year business cycle, during the expansion phase, you get more credit in the system. Some of it's constructive, but then towards the end of it, you start to get, kind of malinvestment. People get overexcited about the market. They start, kind of losing their discipline. And then some sort of external catalyst comes along or some sort of policy error or something, and you get a recession, a deleveraging. And so you reduce that debt. The problem is the policymakers come in and they try to prop that back up rather than letting it run its course. And so when you kind of, basically you short circuit that deleveraging. And so debt doesn't go down to where it started. Interest rates end up at a lower low. And so debt starts going back up for the next cycle without having fully deleveraged. And so when you string multiple of those business cycles together, you get higher and higher debt as a percentage of GDP. You get lower and lower interest rates until you find out what we had, in 2008, and then especially here in back in 2020, was the interest rates are zero, and there's all that debt in the system, and everyone's so highly leveraged that their next mechanism is to go down that fiscal policy route, which is actually where you get kind of that consumer price inflation. So I think a lot of these prices that went up will not go back down. And so people holding cash or bonds got devalued. We're also seeing that bond yields are well below the inflation rate. And so I think that the bond market's very complacent, partially because it's being, indirectly kind of held down by the Fed. And so, I think that those are actually pretty big problems for certain types of investors in those assets. And I think, say we've gotten past like the lumber spike, for example, but as you go farther into this year, now we're looking at rent inflation. And then the big question, the long-term question, is what happens with wage inflation, right? Because it's hard to get really persistent inflation without wages going up, because eventually that kind of limits demand for goods and services. But if you start to see a kind of feedback loop of wages going up, that's how you get kind of that stickier type of inflation. And so you saw that in the 70s, for example, whereas, we're kind of in the early stage of that now. So partially from, we've had 25 years or so of globalization, right? Ever since the mid 90s, we've had this big structural trend of globalization, and that's put a lot of downward pressure on wages. And there's other factors like unionization, things like that, but really the biggest factor overall was globalization combined with technology, automation. We found all sorts of different ways to hire cheaper labor or automate something, whereas in the previous decades we would have had to actually increase wages for workers. And so if we start to see signs of that trend reversing, which I think we have, globalization hasn't really reversed, but it has kind of stopped growing. So if you look at, say, global trade as a percentage of global GDP, that was in a multi-decade structural increase, but then it kind of topped out, and we've been kind of holding whatever percentage that is for several years now, right? So and I think this whole kind of pandemic situation kind of highlighted some of the risks of extreme globalization, where in the early phase of that pandemic, the United States says, wait, we can't make ventilators, we can barely make masks, we have to ask China for masks, and we find out that most of our pharmaceutical components are made in China, and we say, well, that's not kind of a good thing from national security, right? And so I think we've kind of topped out in terms of globalization, and if indeed we start to see more of a political will to reshore some of those supply chains, that we go back to the early thing. We spent 25 years increasing efficiency at the cost of resiliency. And if we start kind of going the other direction, we want to increase resiliency and increase domestic, opportunities. That will probably come at the cost of efficiency, and therefore come at the cost of higher inflation.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.